Most people believe they understand gold and silver. They think that when stocks crash, gold and silver automatically go up, that they're instant safe havens. But this belief is dangerously incomplete. Because when markets first crash, gold and silver often do something that shocks people. They fall too. And that misunderstanding is exactly why so many investors panic and sell at the worst possible moment. Today, we'll walk through what actually happens, step by step, so you understand the sequence and the psychology. When a stock market crash starts, the problem isn't fear. It's a crisis of liquidity. Hedge funds face margin calls, institutions need cash immediately, and forced selling begins. At this stage, investors don't sell what they want, they sell what they can. And gold, being highly liquid and globally traded, gets sold to raise cash. It falls not because it failed, but because it worked as an ATM. This is where people get confused. Gold is not a crash hedge, it's a monetary hedge. In the early chaos, the dollar often rises as everyone scrambles for cash. In 2008, gold dropped 30% at first. In March 2020, it sold off hard. This is where weak hands exit, wrongly concluding that gold doesn't work. Silver's story is even more volatile. It's both a precious metal and an industrial metal. During a crash, industrial demand collapses. This is why silver often falls much more than gold, sometimes 40% or 50%. People buy it thinking it's cheap gold, then panic when it amplifies the crash instead of hedging it. But then, the turning point arrives. Central banks step in, rates are cut to zero, liquidity is injected by the trillions. Quantitative easing begins. The crisis shifts from a liquidity problem to a confidence problem in the currency itself. And this is when gold wakes up. It's not insurance against falling stock prices, it's insurance against currency debasement, policy desperation, and the loss of purchasing power. That's why gold often lags the crash, bottoms quietly, and then trends higher for years. It doesn't protect you from the volatility, it protects you from what policymakers do because of the volatility. Silver's recovery comes later, but it's far more explosive. Once liquidity returns and growth expectations rebound, silver doesn't just recover, it surges, often in a violent, emotional, and extreme bull market. It punishes impatience but rewards understanding. So here's the sequence. Stocks crash and everything sells off, including gold and silver. Central banks respond, weakening the currency. Then gold rises steadily, and finally silver explodes later. If you don't understand the sequence, you panic. If you do, you stay positioned.